Hello everyone, Realtor Monica Davis here with Monica Davis Group in our webinar today. Today we have a very special topic about how we can help these buyers with some down payment programs that are very important and special for you right now. So the market is moving really fast and buyers are looking for the perfect deal in an affordable price and for the perfect rate. And today we have one of our best preferred lenders from Loan Depot, Mario Serrato and Luis Arizaga, who are going to take us deeply into how we can help the buyers right now and how can you prepare yourself to purchase your home sweet home. So with no further ado, welcome Mario and Luis to this webinar.
Hello, everyone.
Hello, everybody.
Hope everyone's staying safe. I'm Luis. I'm the sales manager, and I'm here with Mario, which is my area manager. We're going to be discussing down payment assistance programs, and Mario is the expert in this topic. So I'm going to turn it over to Mario.
Luis, you're not too shabby yourself. You got it. You understand it. Well, thank you for having me, Monica. You've been a great referral partner. We appreciate the partnership that we have together. I know Luis speaks highly of you, and we've done some pretty nice work with your buyers and helped out a lot of families. So what I'd like to do is just to give you an overview of what down payment assistance is. So in today's market, the one thing that sticks out the most of the demographic that we like to cater to the most, and it's the demographic that's up and coming, is the millennials. So we do a lot of work with the millennials. And one of the problems that we have with the millennials is down payment assistance. So they have good jobs and they have steady income, but they don't have the down payment. And so by using down payment assistance to help them buy, this helps agents realize more commissions and help more families, put them in homes. So if you are a person, let's say you're in your early 30s, late 20s, and you are you got your job, you have your steady income, but you don't have the down payment, because getting a 3% down payment is not as easy as it sounds, especially if you have a lot of student loans. And then for the older generation, some of these programs, you don't have to be a first-time home buyer, so it allows you to upgrade your home and use some type of assistance to help you with the new down payment. So I have a presentation that I would like to show you guys whenever we're ready. Monica, you let me know if you want me to dive into the presentation.
Yes, of course.
Okay,
of course.
Perfect. So let me share can you share the screen for me?
Yeah, we can see it.
Oh, you can see it, okay.
Yeah.
So here's the fear. I don't have the money for a down payment. And here's the fact. There are a variety of down payment options available to you. We're going to dig deep into the programs that we have that are available to pretty much anybody in the audience right now. So separate yourself from a pack. If you're a realtor and you're not offering this, your competitors are. So I know Monica is a big believer in offering these programs to her buyers, and she's helped many families that otherwise may not have been able to buy a home. So maybe you get somebody that's interested in renting, or if you're interested in renting because you don't have the down payment, but you have the credit and the income, this could make you a homeowner. We all know that in America, the easiest way to build wealth is through home ownership. If you own a home today, and if you fast forward 5 years, you're going to have about $40,000, $50,000, $60,000 in equity. If you invest some money today and fast forward 5 years, you might have an extra $2,000 or $3,000. It's a huge divide between being a homeowner and just trying to save money. You have tax benefits, you have pride of home ownership, you have equity, you have a nest egg built in with having a home. So owning a home is the way to go, and I recommend it for everybody. When I see young people that are new, that are coming into the job market, the first thing I tell them is you can own a home. And they look at me like I have two heads, because in their minds, they're still kids. How can I own a home, right? But it's incredible how I did a loan for a lady who is, she's a doctor now. But I did the loan for her 5 years ago when she was in school and she had a part-time job, and we gave her a down payment assistance loan 5 years ago. Okay, so now when she graduated school and became a doctor, she had about $200,000 in student loans. Well, that condo she bought for, I think, $175,000, $200,000 is now worth $350,000, and she sold it and she paid off most of her student loans. Smart, right? That's
Yeah.
that's like a perfect example of how it should be done. So when you have a young person, they have to be encouraged to do this. It's scary, but 5 years from now, they're going to be thanking you profusely, and you have a customer that's very grateful, and you have an incredible referral source there. So that's a nice little example that I like to give, and it's a real life example. So that's why I put this slide here to separate yourself from a pack. You know, everybody has experience, everybody has good service, everybody has expertise. You know, they have good partners, but do you offer down payment assistance? Do you know that down payment assistance is more than just for first-time home buyers? So let's dig in. So we just talked about that, be the agent that knows down payment assistance. And here are some of the borrower benefits. You get reduced mortgage insurance. When you don't put 20% down on a home, your mortgage, you have to pay mortgage insurance. That mortgage insurance is less expensive with these programs than the regular program. Down payment assistance, borrowers can receive up to 5% in grants, free money, or up to $10,000 in a 0% second mortgage. Now, what program you qualify for largely depends on your situation. How much money do you make, what the sales price is, and what you really qualify for. So determining the program is pretty much the art of this, and then the rest of it is science. So borrowers are exempt from doc stamps. So what does that mean? That means that the closing costs are going to be slightly less on that end. And we can pair this up with a program called Mortgage Credit Certificate. So what the Mortgage Credit Certificate is an IRS program. This IRS program will allow you to get up to $2,000 in a mortgage tax credit on your personal tax returns every year while you still have this loan. So if you are, let's say that you did your taxes and you owed $500, well, you wouldn't owe that money anymore. So this is something that can help you. Borrowers are exempt from doc stamps. We talked about that. We talked about the MCC. Now, we already talked about the realtor benefits, so let's move forward. So a couple of terms to understand. What is a first-time home buyer? A first-time home buyer means that you're exempt. That means that except for borrowers purchasing in, well, I'm not going to read it like that. So there's something called targeted areas. We'll talk about that in a second. A first-time home buyer is someone that has not owned a home in the last 3 years that they've lived in. So, for example, if you own a home in Pennsylvania, let's say, and you've had it rented, or it's a second home, and you're declaring that on your taxes, you are considered a first-time home buyer, as long as you haven't lived in that home for 3 years. If you've never owned a home, you're a first-time home buyer no matter what. But if you do have a home, as long as you haven't lived there for the last 3 years, you're still considered a first-time home buyer. The next term I want you to understand is household income. Household income is the amount of money that everybody that's 18 years or older in your home makes. So, for example, if you have a child that works at Publix, well, their income is part of household income. And some programs require household income. Some programs require the next term, which is program qualifying income. We call it, in our profession, we call it 1003 income, because 1003 is the loan application. So most of the programs use this, and it's to our benefit because we only have to count what we want to count on the application. So, for example, if a borrower makes a lot of overtime, and that overtime pushes them over the income limit, we can choose to not count that overtime and have them qualify for the program. I know it's a lot, it's technical, but that's something that Lewis will evaluate and determine what, if we need to use it or not. The grant. So what exactly is a grant? So there's two flavors in the grant. The first one is 100% free money. You don't got to pay it back the day you close. Whatever free grant money you got is forgiven immediately, and you never have to pay it back. And then we have another type of grant, which is called a soft second. And what that means is that it's not immediately forgiven. In other words, you still owe the money. So let's just, as a simple example, let's say you got a $10,000 non-forgivable grant, a soft second. What that means is every year, 20% of that grant is forgiven up to 5 years. On the 5th year, that's it. You don't owe it anymore. So if you sold your home on the 3rd year, you would have been forgiven 60% and you still owe 40%. Okay, so I'll just let that sink in a little bit. That's what a soft second grant is. And then the MCC is the IRS program that we just talked about. I don't know if we're stopping for questions or if we're saving them for the end. Monica, how do you want to handle this?
Well, everything seems very interesting. I think that we should leave the questions for last. That way,
Okay.
and if
Okay.
if I come across any other question, I will let you know.
Okay. So here, this is the important details that we need to. I put the big little thing that says critical. This is probably the biggest mistake that is made on these programs. There's two qualifying factors on top of the normal qualifications, which is income, credit, assets. Those all exist. Those don't go anywhere. But these programs have two additional qualifying factors. One of them is income limit, and the other one is sales price limits. So these programs, depending on the county you're buying in, has an income limit. So for example, Broward County might be 98,000, and Dade County might be 80,000, and Palm Beach might be 105,000. The same thing with the sales price. The sales price is different per county, so we have to evaluate. So one of the first questions we ask when we know you're going to use down payment assistance is what county are you buying in, and how many people live with you. Those are two critical factors, and then we verify income, and then we figure out what program fits for your scenario. So it's critical that you clearly understand these two components before offering the product to your buyer. Loan officers have to be certified in this program. Not any loan officer can do it. So not only does the loan officer have to be certified in it, but the company has to be certified in it. So you're not going to find a small little mom and pop shop offering these programs, because these programs have a certain responsibility after closing that has to be fulfilled by the lender. And if you're a small company, you're not going to get approved to do it. So not every company can do it. Of course, Loan Depot can do it. And of course, Lewis is certified to do this program, these programs. So I'm not going to read this whole thing. This is, these are the four major programs that we offer that offer down payment assistance. So I'll touch on each one, and then we'll dig into each one individually. Okay. So you can pull your hair out if you don't know. There's just so many programs. It's very difficult to get lost in the minutia. And so, I mean, even to this day, we always have to kind of like put our heads together to make sure that this is the program that fits best for the customer. So Florida Housing is a state agency, and they cover the whole state, every county in the state. So when somebody says, what if my county doesn't offer it? I say, no, don't worry about it. We have a program that covers the whole county. Now, we don't always use that one, the whole state. We don't always use that one because it's not always the best one to use. So this one will let you use Fannie Mae, Freddie Mac, and FHA. It'll let you use all three of the agencies. It has a 3% or a 4% grant based on the sales price. And this is the one that's forgivable 20% per year up to 5 years. So you see that there? So I put in red letters OR because they offer this other program called the Florida Assist. The Florida Assist is a $7,500 second mortgage. It is not forgivable. When you sell your home or when you refinance, you will have to pay that money back. But there's no payment on it. 0% interest deferred for 30 years. You can pay on it if you want and pay it down, or you could pay it when you sell your home or you refinance. I like realtors to know that because usually when you sell a person a house and they buy their next house, they're probably going to call you, right? And I don't want them to be surprised that they owe this $7,500. So it's important that you as a realtor also, remind the customer maybe on the day of closing, or, tell them, hey, remember you have a second mortgage here. And maybe you make yourself a note in your CRM that when you sold them this home, they use this program and they have to pay back the $7,500. So when you do their net sheet to figure out what their proceeds are going to be, this has to factor in. So, and if you look at the next OR, the next OR says that there's a second, a $10,000 mortgage. And this is also a second mortgage, but this one has a payment attached to it. It's based on a 3% interest rate, and it's for 15 years. So this is paid off in 15 years. The payment is not that bad. It's $68.89. So the idea is when the 15 years are over, you have this $10,000 paid off. You can pay ahead of time if you want, or if you sell your house before the 10 years, you just have to pay whatever the payoff is. But it's $10,000 is a little better than the $7,500 on the previous one. The difference between the $7,500 and the $10,000, apart from the money, is the payment. The next program, which is our most popular program, we love this program, and you want to know why we love this program? Monica, why do we love this program?
Why do we love this program?
Louis, why do we love this
I
program?
think it says Miami. Is that the
It's a
number
great
D,
program.
right?
Letter B.
Letter D, right?
B as in boy.
B as in boy.
Louis, why do you like letter B?
Well, I like because one is a grant. It's free money.
Free. It's free money. That's why. This one is truly free money. And here's another reason why we love this program. You don't have to be a first-time home buyer. I didn't put that there. I should put that there. So this is one of our best programs because one, it's free. Two, you don't have to be a first-time home buyer. Number three, it uses application income. That's so important. There's been so many times where we're using a program that uses household income and the borrowers don't exceed the income limit, but because their kid works, they do exceed it. This program does not have that problem. This uses only application income. Now, this program also does Freddie Mac, which is a conventional loan, but only for borrowers that make less than a certain, very low income, like $57,000. So it's not great for conventional, but it's beautiful for FHA customers.
So this one is only good for FHA, right?
Yes, you can do conventional, but very low end sales prices. Maybe a borrower that's buying a condo or something like that, they have to make less than $57,480. So that's pretty difficult. So that's the only program that they have in conventional. But for FHA, it's a great program. You can go up to about I think it's like $400,000, but the maximum loan size for FHA is like $373,750. I don't expect you to remember that, but that'll be a limitation. So this is
I have a question here on the audience. Where do they go and where do they go? They say, where do I go and get this type of grants directly? Is it with you or is it in
through us.
You see that guy with the glasses with the picnic shirt on? Him.
Yes.
So,
so you will help them to do the application or whatever it takes for you to. Okay.
So when a borrower wants to apply for this program, the only thing extra that they have to do that's apart from the normal stuff like W-2s and pay stubs, if they have to take an 8-hour home buyer education course, and they can do it online.
Okay, perfect. Is that the one that costs like $75 or something?
It's free for this program. It's free for the grant program. It's free.
Okay. Okay.
For letter D, it's not free, but for this one, it's free.
In other words, when we come across with a buyer, okay, what you do in your expertise is that you qualify the buyer, and depends on their qualification, you start looking at what benefits they can get at that time for any program that it could be allowed for them to take advantage of, right?
Louis?
Yeah. It's going to be a combination basically of their income, their credit score, but we'll see which option better fits for them once we have the application and which one is more beneficial. Because you see some are already set amounts like 7,500, 10,000, but there's other ones that are 3 or 4% or 5%. So those could be, higher. So that's something that we look into once we have the application, and depending on the sales price and the size of the loan.
Okay, very good, very good. Okay, so that answered the question. Thank you.
Yep.
Okay, so the next program is called it's the same organization, HFA of Lee County, but this is a second mortgage program. I do want to mention something that, Louis, could you do me a favor and pull up the counties covered by the HFA of Lee County grant?
Okay.
And if you could rattle them off.
Yeah, let me pull it up. So HFA Lee County.
Yeah, go to summary. Once you're in the website, click on summary and you'll be able to see it.
So the counties that it covers, you said?
Yeah.
Yeah, it's Broward, Charlotte, Collier, DeSoto, Lee, Palm Beach, Sarasota, St. John's, and Volusia counties.
That's for the grant program?
This is for, yes, this Opportunity Grant Program.
Yeah. So I wanted to mention that because if you notice that the letter B says HFA of Lee County, but it covers about, how many counties was that? 7 or 8?
Yeah, it's about 8.
Yeah. So if you're buying in Palm Beach, if you're buying in Volusia, Charlotte, Lee, I mean, there's various counties that you can use it for. So I wanted to point that out. Now, the next one is the same organization, but they have a second mortgage program. So it is not forgivable. You do have to pay it back. It does not have a payment, and it's $10,000. The problem with this program and why we don't offer it that much is, well, actually it's the same. You could do FHA, VA, or conventional with Freddie Mac, which is, they're like Fannie Mae. They're like the ugly stepsister of Fannie Mae. It's called Freddie Mac, and it's a regular conventional loan, but they put a limitation on the income less than or equal to 80% of the area median income, and it's different for every county. But on average, is between $45,000 and $57,000, which is not a lot of money. So it's not a very popular program for us. We have used it, but it's not very popular. And then the last one that there's other programs, by the way, guys. I just pointed out the most popular ones. These are the 4 most popular ones. And then the 4th one is HFA of Miami. This one is strictly for Miami. And it works very similar to all the other programs. But it's $10,000, 0% interest rate, no payment, but you do have to pay it back. So let's, Louis, while we're doing this, could you do me a favor and pull up the HFA Lee County maximum income limit to give the audience an idea of what's the most income you can make for this program?
Yeah, let me pull it up real quick.
And then we're going to go over some tips on choosing the right program. This is really for us, but I wanted to give you an idea of where our head is when we're trying to help you pick the right program for that fits your situation. So it could be because of income. Go ahead. What is the income limit for the free money program, the grant program in Broward?
So Broward, it's 112,200. Palm Beach is 118,000. And we have.
What about the sales price limits?
It is Broward is 331,888. Palm Beach is the same, 331,888.
Okay. Yeah. So you could say you could buy a home for $330,000, make a little over $100,000, and you still qualify for this program. Now let's put this into perspective a little bit. You're a first-time home buyer. You're not buying $1 million home. You're more than likely buying something in that range. Monica, would you agree with that?
Yes, I do.
Okay. So this program is not for everybody. If you're looking for a $500,000 loan, well, you're doing good for yourself. You probably don't need any assistance. But for the first-time home buyer that's trying to get into their first home, this is an excellent, excellent program. Okay, so here are some tips on choosing the right program. So free money is always better than a second mortgage. Everybody can agree with that, right? Everybody wants free money. So it makes sense to take a grant a lot of times, even though it may be less money, but it's better than owing a second mortgage. So for example, let's say that your sales price is $250,000, right? Mm-hmm. And you're taking a 3% grant, which is free money. That's $7,500. So 250,000 times 3% is $7,500 of free money. But you can also pick a $10,000 second mortgage program. You're going to get more money at closing, but you owe that $10,000. If you take the grant, you don't owe it. It's free. So although it's a little bit less money, you don't have to pay it back. So that's the kind of evaluation and consultation that Louis will have with your borrower and with the agent, so everybody can be on the same page and they can make an intelligent, informed decision. All right, so the first example I just said, sales price is $275,000. You take a 3% grant, that's $8,250. That is less than $10,000. The second mortgage, $10,000, but it might make more sense because the grant does not have to be paid back and the second does. Okay. Another example, your debt to income ratio is tight. So if you choose a $10,000 second mortgage program from Florida Housing, that has a payment of $68.89. And maybe because of that small payment, you don't qualify. So in that scenario, you may want to choose the $7,500 Florida Assist. It's less money, but you'll qualify because it doesn't have a payment. So this is the kind of back and forth that Louis and I do every time we're evaluating customers. Here's a third example. The bar is buying a $225,000 home in Miami-Dade County. They're low on cash to close, all right? But they have plenty of room in their debt to income ratio. So in this case, it may be better. So Miami-Dade has a $10,000 program that's going to give you $10,000. You have to pay it back, but it doesn't have a payment. But the payment doesn't matter in this case because the borrower makes enough income. So it may be better to use the Florida Housing State Program, that's wrong. It's not 5%. It's 3% or 4% grant instead of the Miami-Dade $10,000 program, because the grant is going to give you less. It's going to give you slightly less money, but it'll be free. You wouldn't have to pay it back. You'd be forgiven 20% per year. Example number 4. The borrower is buying a $125,000 condo in Palm Beach County, and they're tight on debt to income ratio. The best program would be the HFA of Lee County $10,000 second mortgage program because it doesn't have a payment. If you were to take a 3% grant on this program, think about 3% of $125,000. That's only $3,750. That might not make a difference. So you're better off taking the second mortgage, even though you have to pay it back, because it's a lot higher than just a 3% grant. I know it's a lot. So the other example is number 5 is the borrower's buying a $125,000 condo in Broward County, and they're super tight on their debt to income ratio, which means they're barely qualified. So if you give them the $10,000 second that has a payment, they might not qualify anymore. So in this example, we would give them the $7,500 second because it doesn't have a payment. So I think that commercial where their minds get blown up and purple stuff comes out of their heads. I hope that didn't just happen to everybody.
That's a lot of information.
Yeah.
But look, this is what I tell people. Don't try to absorb all this information. You need to know just enough to understand that you have a benefit, and you got to let someone like Louis help you decide and Monica help you decide what is the best benefit for you. And we'll sit down and we'll evaluate. We'll give you 2, 3, or 4 options, and then you discuss that with whoever you want to discuss that with. Ask your questions, and you'll come up with a good suggestion. A lot of times, the buyers will say, "Well, Mario, just tell me what you think is the best one," and then I'll tell them, "Look, this is the one I think works best for you, and this is why." The last thing you want to do is have a buyer have buyer's remorse. They closed on the loan and they feel like they didn't get the best solution because they just didn't understand the program. That would be a sin. So it's our job to make sure that they clearly understand what program they're getting so they can feel good about the purchase.
That's correct.
So this is the one. This is the second mortgage from HFA Lee County. It's not very popular. Maybe we don't go over so much. Let's go to the popular one, which is this one. So this is the one. It's a grant, and it's not based on the sales price. It's based on the loan amount. But the sales price and the loan amount is very similar. The counties included are Lee County, Broward County, Charlotte County, Collier, DeSoto, Palm Beach, Sarasota, St. John, and Volusia. So for FHA, you can have up to 100, and I think Louis said
112. I think it was
112,000 in income. But if you're going conventional, as you can see, you would have to make less than 54,640. So this program, we normally put FHA folks in here. The program uses application income. We talked about that application income is different than household income. Application income is only what we're using to qualify. It doesn't matter how much their grandma makes, their son makes, just applications. And I'll give you a story about that. So we put a borrower and we try to put them in a program that uses household income. And the borrower made $97,000 a year, and the limit was like $98,800, something like that. They were barely under the income limit. We put the loan in. And the son got a job at Publix, okay? The son has a joint account with the mom. So when we submit the loan to underwriting, the underwriter says this program requires household income. I see a deposit from Publix. Who works in Publix? The son worked in Publix. How much does the son make? $10 an hour. That was enough for them to not qualify for the program. So that's a sad example. We saved the deal by putting them into another program that uses application income. So this is an important thing for Lewis and I. We try to use programs that use application income because they're the most flexible. So for conventional, your minimum credit score is 640, and for FHA, your minimum credit score is 660. Now, it's not all about the score. Lewis, I'll touch on somebody that has a 640 that wants to do a conventional loan. What do you think about that?
If it's a 640, I mean, we can do a few things. We can try to see if we can help him increase the score.
But they have the minimum score, Lewis. 640 is the minimum credit score. Why wouldn't you be able to give them a conventional loan?
Well, right now, because it's currently suspended.
Well, yeah, but the main problem is that nowadays, when you're running the automated systems with that low score, that's what I want you to touch on.
Yeah, no. So, I mean, obviously, if we run in a conventional now, running in a 640 credit score is probably not going to get an approval. So in that case, we're definitely going to try to go with FHA. But if you don't have the score, then we're going to try to get you over in those 20 points, maybe, pay off a collection, a credit card or something to get you over the 660 and get you on an FHA loan.
David.
I'm sorry?
Okay, so what I want folks to understand is that it's not just about the credit score. It's more than that. We run everybody through an automated engine. Some of you may have heard of it. It's called DU, or Desktop Underwriter.
Yes.
There's also another one called LP. It's the equivalent, but for Freddie Mac. And not only do you have to have the minimum credit score, but you also have to receive an approval. And that gets very difficult when you have a 640 credit score. But I'll tell you that one thing Lewis is really, really good at is increasing people's scores. So he comes in with a bar with 640. The first thing he does is evaluate their credit and see what do we have to do to get the score higher to the higher levels to be able to get an approval. So he's pretty good about that. Max debt to income ratio, 50%, but we don't really have to go over that. That's something Lewis and I deal with. You can combine the mortgage credit certificate program with this. Why do we do that? The reason we combine the mortgage credit certificate is because you get up to $2,000 a year on your tax return. If you take $2,000 and you divide it by 12 months, you get $166.67 in income that we can use. So sometimes when we're right there teetering on whether we qualify or not, we may add an MCC. There's a pitfall and a downside to adding the MCC. Lewis, what's that pitfall?
The income.
That's right. We have to use household income when you have the MCC. So that could get tricky. So just a little FYI there. So the income limits vary by county. You don't have to be a first-time home buyer. This is not a second mortgage. The grant is considered a gift. And co-signers are permitted on FHA only. So if let's say you don't make enough money to qualify, but mom and dad want to help you, we can add mom as a non-occupying co-borrower, and her income will help you qualify for the loan. And mom won't be untitled. Mom will just be on the loan note and help qualify. So that's pretty much our most favorable program, most popular, because it's free. You could do 3%, 4%, or 5%. Now you're asking yourself, well, why wouldn't I just pick 5%? Take a look over here. If you pick 3%, look how beautiful this rate is, 2.875. If you pick 4%, the rate gets a little higher. If you pick 5%, it gets even higher. So it depends. It depends on what you want to do. Maybe this is a temporary loan for you. Maybe you want the 5% because it's immediately for. Think about 5% on $300,000. That's $15,000 of free money. And maybe a year, 2, 3 years down the road, you refinance and get a lower rate from 3.75 to the 2s, depending on the market at the time. All right, so the next program is the second most popular program. This is the agency, Florida Housing, that covers the whole state. Okay, this agency will give you a 3% or a 4% forgivable, 20% per year, and is fully forgiven in 5 years. Everything else is pretty much the same. almost identical to the other program. It uses application income. The minimum credit scores of this are similar. One difference: all borrowers do have to be first-time home buyers. Here are the rates. You see the rates are a little bit higher, but they do conventional. That's why we use this program. We use this program for conventional grants. They don't have an FHA grant program. So when they're in Broward County, we put them in the program that I just discussed. When they're in every other county and they want a grant, we put them in this program. Co-signers are not permitted on this. Mom cannot help on this program. So as you can see, there's a lot of little details that we have to factor in. This one has the, if I go to the next one, the same agency has the $7,500 program. It's a second mortgage, no payment required, and it's not forgiven. You got to pay it back. And then this agency also has the $10,000 program. This does have a payment, and it's not forgiven. You do have to pay it back. The payment is $68.89, I believe. Same thing. You have to be a first-time home buyer. No co-signers permitted. So a lot of detail in these. And then, no, that slide's not for you. And then we have the Miami-Dade program. So the Miami-Dade program is similar to all of these. It's $10,000. It's a second mortgage, and you do have to pay it back, but it doesn't have a payment. So sometimes people are buying in Miami, but we won't use the Miami program because it's better to give them a grant because it's free money. At least it's free. In 5 years, it's forgiven. 20% is forgiven every year. So, you know, everyone, I do this at realtors, and I do it for borrowers too. You know, I give them a challenge. I say, look, take your phone out, go to Instagram or Facebook, and post something like this. Hey, looking for a home and you don't have the down payment, call me and I'll show you how we can get the down payment for you. And you'd be surprised how many borrowers call their moms, their dads, their uncles, their aunts, their friends, and end up buying a house because they didn't know about this program. Or how many realtors start getting more clients because now they'll call all the people that they rented to a year ago and say, hey, I got a program. You could be a homeowner now. You know, think about it. You rent a home to somebody today, and a year later, if they would have bought, they probably would have had $20,000 or $15,000 or $30,000 in equity. So, look back at people that are renting and maybe, convert them into homeowners with this program. So what does Loan Depot do for you? Or better yet, what does Louis from Loan Depot do for you? Well, we can help those borrowers that do not have the full down payment and give expert analysis to you, the realtor, agent, and to your buyers, to you guys, the borrowers. So this is something that we do, we believe in. We probably, out of our production, 25% of our production are bonds and grants and MCCs, mortgage credit certificates. So we're probably the highest in the state of utilization of these programs. And we often get invited to be expert speakers at the agencies. That's how much we use these programs. So they love us and we love them. So that concludes my my presentation. Monica, I hand it back to you.
Thank you, Mario. Thank you very much for every single detail of every program that each buyer can qualify, and I can't wait to find the right buyer and bring it to you. Usually, what we do before we show homes for the potential buyers, we always want to do a pre-qualification first to make sure that what program and how much they are pre-qualified in order for us to go and find that dream home. Why we do this? We love to help buyers, but to help buyers in the right path. It is unfortunate that sometimes they go and look for homes and they fall in love with a home that they cannot afford. And now, with in partnership with Luis and Mario, we have helped many families, and we have guided them through the right path. And with these programs, I'm sure that many buyers at this moment are going to take advantage of these amazing grants and possibilities for them to own their own home. I was thinking about the millennials, and we have helped so many millennials right now that they come across with what you mentioned, Mario. They have great jobs, they have a steady income, and they have a great credit score, but they don't have money for the down payment. So if this is you, give us a call. We will be more than happy to help you and guide you through the process. I can tell you for experience that Mario and Luis are experts in that area, and we have helped very many families achieve their realty dreams. Now, I have some questions for you, Mario and Luis. Okay. Um, I have a person who asked, what is debt income ratio? Why is this always in the words of a lender? Why is so important?
Louis, you want to take that one?
So your debt to income ratio is basically the percentage of what you know are going to be paying monthly out of your monthly income. So if you make an example, $1,000, your debt to income ratio cannot go over a certain percentage, which could be in this case 45, 50%. So no more than 500. I'm just giving you an example, $1,000, more than $450, $500 a month. You can't go over that in expenses monthly, including, your total expenses, car, credit cards, mortgage, any other loans that you may have, and even co-sign loans. So that's what the debt to income ratio is. Different programs have different qualifications. The debt to income ratio for some are 45, for some are 50. Some you can even go a little bit more. So that's something that we look at when we put you in the right program for you.
So from mathematically, the way, if some people like to calculate it themselves, what you do is you take your proposed mortgage payment, you add up all your car payments and your minimum payments for your credit card, student loans, any loan that you have, and you take that number, which is all your debt, your monthly payments, and you divide that by your income. And that is the ratio that lenders use and the automated engines use to determine if you qualify. And the maximum on these programs is between 45 and 50%. There are other programs that don't provide that much assistance that you can go to 57%. But typically 45 to 50% is what you can expect to be able to qualify for these programs. So that word that you're saying, why is it always there? Is because one of the most important factors in determining whether you qualify or not.
Very good, very good. Okay. Another question. If I am a 1099, would that be a good an obstacle for me to apply for these programs?
No. If you're 1099, you pretty much are independent. You're considered self-employed. So in this case, we're going to ask you for your 2 most recent tax returns, review them, see what you reported to the IRS. And then based on that, it's what we're, depending on what you reported to the IRS, is what we're going to use to qualify you. But no, it doesn't. Now, if you were W-2 and, you turn into 1099, you only been working a month for 1099, that's a little bit different. You don't have the history. Typically for 1099, you need a 2-year history reported in your tax returns. So, but no, it doesn't disqualify you.
So I'll add a little more color to that.
Yes.
That was a very good explanation, Louis. Thank you very much. But just to because and I say this because I get this question a lot. So a borrower will come to us and they'll say, I make $100,000 a year at 1099. Okay. In their mind, they make $100,000 a year, but when they present their tax returns, how much do they make, Louis? Like $10,000.
Yeah.
So they report 100,000 at the top line, and then they deduct this, they deduct that, they deduct the sink, they deduct their family members, they deduct everything, and they end up with only making $10,000, $15,000, $20,000 a year. We don't use the top number; we use the bottom number. So oftentimes people think they qualify for more because in their head, they know what they bring home, but that doesn't necessarily translate into what we can use.
Okay. I have an audience here. Yvonne is asking if this program is offered in Broward County too. And Luis, what do you say?
Yeah. This program is definitely offered in Broward County. That's one of the main counties that we work, on, and that's Mari went over. It has a 3%, a 4%, and a 5% assistance. But yeah, it is offered in Broward.
And Broward County is actually the best one because it's free. It's free money.
Okay, Yvonne, we will definitely be in touch with you. And another question here is, um, I am an immigrant, okay? I own a business. I am not a resident. Um, my business is making money. I want to buy a house, but I fear not being able to. Can I be a homeowner with these qualifications?
Lewis.
So, I mean, if you have a work permit and you have your social,
Yes.
we are able, I mean, there's a little more to it. We got to make sure that it's obviously not expired, that it's not going to expire soon. But yeah, you don't have to be a resident or a U.S. citizen. We can definitely use work permit, but you do need a social.
Okay.
And as far as the self-employed part that own their own business, they have to have owned it for 2 years, and we have to see what they're declaring.
Okay, perfect. Very good, very good. Okay. Another one. I have submitted multiple offers and they have been denied. They ask for the DU, for the DU, and they submit it, but they say that they didn't get any success. So I'm going to answer my part, and then I let you answer yours. If you are running through this difficulty, Monica Davis Group is more than happy to help you and guide you through. And we will connect you directly with our preferred lender, Loan Depot, Mario and Luis, and they will let you know and help you how to fix that. And first of all, Luis or Mario, can you remind our audience what is EDU and answer this question?
Lewis?
DU is basically an automatic underwriter, like a computer underwriting, that it picks up how we structure the loan, the application. It picks up your credit score, your assets, your accounts, and we run it through the system, and it gives us a report that says that you've been approved, pre-approved, and it's just a document basically that we can provide, I guess, to realtors and to sellers to make them feel a little more comfortable when presenting an offer.
Okay.
Yeah, so the reason they asked for this is because I don't like giving it out, and I'll tell you why. It's got a lot of the borrower's personal information.
Yes.
So I typically like giving only the first page that says it was approved. But we're in a competitive environment that we are in, as long as the other realtor understands that this is confidential information. They like to see it because it shows how much money they make. It shows what their credit scores are. It shows what their debt to income ratio are, because a lot of realtors are now very savvy on how this works, and they don't want their seller to take their house off the market if we don't have a real qualified buyer. So that's why this phenomenon is happening, and they're asking for this.
Thank you, Mario. Okay. Is there something else that you would like to add? From my notes, I know that letter B. Can you remind me the name of that program? You say that that's the best program because it's a free money
Yeah.
that we take advantage of, right?
Yeah, the HFA of Lee County, which is the grant.
The FHA of Lee County, yes. Okay, and remember that if you haven't owned a home in the past 8 years, you are considered a homeowner. We know that in the
3 years.
I'm sorry?
3 years.
3 years. Okay.
Yeah.
Okay. Thank you
But
for
for that program B, you don't have to be a first time.
You don't have to be.
You don't have to be. Okay. So right now, with all of these programs, we are ready to help you and serve you in the best way possible. And the last question: how do you see the market moving in the coming 6 months? Are the interest rate are going to change? What is your forecast for us right now?
Okay, so of course this is just an opinion, right? Everybody has an opinion based on our experience and what we've seen in the past. I don't think that properties are inflated. I think that we have a healthy increase in property values. It's not an exaggerated one. And I also want to remind everybody, because some people like comparing what's happening now to what happened in 2006, 7, and 8. What happened in 2006, 7, and 8 was a real estate related situation. It's called the real estate bubble for a reason. and properties were overinflated by 100 and 200%. Today, what's happening is we have a pandemic that's not related to our industry at all. It's something that's a health issue. Now, because it's a health issue, it has affected businesses. Because it has affected businesses, it has affected the stock market. Because it has affected the stock market, the federal government has to intervene to stabilize the economy. How do they do that? With the number one lever that they have, interest rates. So they control the market, they control the hysteria, if you will, by decreasing the interest rates. And that's what they've done. And by doing that, they've sparked the industry. More people are selling. We don't have enough inventory for the amount of buyers that we have. And that's why you're seeing properties being scooped up quickly. So if you're in the market, if you're a serious buyer, I would highly recommend that you get fully pre-approved. So when you submit your offer, there is no wasting of time. You immediately submit your offer. You show them the DU that you need to show them. You show them the pre-approval. And by the way, Louis and I oftentimes speak with listing agents to tell them how qualified our borrowers are. And so I see that the interest rates are going to stay the same for a very long time. I see third quarter of 2021. I think that we're going to be looking at the same interest that we're looking at today.
Okay, very good, very good, very good. We also see a healthy market coming and continue to be stable. We have a lot of buyers online in the line ready to see properties. It is crazy to go to a listing, to a showing appointment and see a line of cars. Like, I'm sure that you have witnessed caravans for birthdays and everything like that. You could see caravans ready to see homes. This is real.
Crazy.
It's crazy, but there are many opportunities for you right there. Take advantage of these opportunities. We don't know how long it's going to last, but if you have and you meet the criteria, or if you just have questions, give us a call. We're more than happy to answer every single question that you have. We are here to serve you in the best way possible. Thank you.
Monica, can I say one more thing?
Sure.
So this is not a down payment assistance point, but I think based on what you just said, you kind of sparked my mind. The market for the houses that are ready to move in is hot.
Yes.
Hot potatoes, right? Caravan. Everybody wants it.
Yes.
But the properties that need help, that are not livable, that need to be rehabbed, you don't see people jumping on those so quickly. Maybe they're livable, but not exactly what you want. We offer renovation loans. You can get a renovation loan to completely renovate the property. And let's say the property is selling for $300,000, and if you fix it, it's worth, I don't know, $400 or $375. We can give you a loan to cover all of the expenses of fixing that, putting your own cabinets, putting your own appliances, change the flooring, fix the roof, things like that. We can do it, and we can give you a renovation loan. And the property, you only have to put 3.5% or 3%, depending on the program, of the future appraised value. So let's say, the appraised value plus repairs. So let's say you're buying a house for $300,000 and the repairs are $50,000. Your down payment will be based on $350,000. And that $50,000 can be used to fix up the property however you want. Now, the renovation program is often stereotyped or typecast into houses that are not livable, but that's not true. You can have a perfectly clean house, but you don't like the colors. You don't like the room distribution. You want to move a wall. You want new cabinets. You can use a renovation loan for that also.
Very good.
So I just wanted to throw that in there. No down payment assistance though, just a renovation loan.
Okay, and the interest for those loans are?
So the interest rate is slightly higher on those loans, and it's going to be based on credit because there's additional risk. So you have, once you close on the loan, you've already picked your contractor because they have to get approved, and you got 3 months to do the work. And we don't give the money to the borrower. We give the money to the contractor in phases as they pass the permitting process. Okay. And when you're done, if you have any money left over, we reduce your principal.
Very good. Very good. Very good. Very good.
Just wanted to throw that out there.
So this is the icing of the cake. We are ready for you. Any questions? Like I say, we are here to serve you. Carolina Bryce, Roberto Lizarde, and myself, Monica Davis. Just give us a phone call. We are here to serve you and to help you making your realty dreams a reality. Thank you, Mario and Luis, for your time,
Thank
and we
you.
continue to do business
Thank you.
together as always. Have a
Thanks.
wonderful day,
Have a good
everybody,
weekend.
and we wish you a good afternoon. Happy weekend. Bye bye.
Bye.